Welcome back, everyone. Before we finish up our Chapter 8 Master Budgeting coverage here, I wanted to do a couple of quick review questions. First up, an activity-based costing system, hint Chapter 7, that's designed for internal decision making will not conform to generally accepted accounting principles, GAAP, because what? So look these over, pause, and come back for the solution. The answer there is A. Under ABC, some manufacturing costs, mostly the cost of idle capacity and those org sustaining costs, will not get assigned to products. So GAAP says all manufacturing costs have to be assigned to products. So ABC not GAAP compliant. Suppose a firm uses an ABC system and defines activities for everything they do throughout the organization. In this scenario, paying executive salaries is an example of a blank level activity. Pause this, think about that, and come back for a solution. The answer there is organization sustaining. So all those were all those top of the house type costs, finance, legal, HR, IT, executive salaries, and then even just org sustaining at the facility level. So like property taxes, insurance, maintenance, things like that. All those things get lumped into those activity cost pools for org sustaining activities and do not get assigned to products or customers. Next up, a company's break-even point is the point at which of these following is true, A, B, C, or D, none of the above. Again, pause this real quick and then check your solution after you've thought about that. The answer there is B, the total contribution margin equals fixed expenses. So if you think about the flow of that contribution format income statement, CM minus fixed expenses equals net income. So if net income is exactly zero, which it is at the break-even point, CM has to be equal to those fixed expenses. Okay, assume a company has two divisions, A and B, and Division B's performance last year is summarized below. Also assume the company's common fixed costs represent executive salaries. If no changes are expected to Division B's performance next year, so demand, cost structure, and so on, and no changes are expected to Division A's performance either, would eliminating Division B make the company more or less profitable in total? So here's Division B's performance. We've got sales of $350,000, contribution margin of $75,000, traceable fixed expenses of $50,000, so a segment margin of $25,000. Then we've got allocated common fixed expenses, $50,000, and segment margin less those allocated common fixed expenses of negative $25,000. So pause this, think about the question there, and then come back for the solution. So the answer is that eliminating Division B here would make the company as a whole less profitable. And the key is that the segment margin is positive. This segment is contributing something toward the company's overall potential profitability. Now, right now, the company as a whole is allocating these giant common fixed expenses to a bunch of different divisions, potentially distorting the view of profitability of each division. We said back in Chapter 6, we probably don't want to do that. That segment margin is our best indicator of the division or segment's contribution to company profitability. Okay, so a couple more things here in terms of our master budget. Learning objective 7 was to prepare a selling and admin expense budget. So let's assume at Royal, we'll continue that example from our previous videos, the selling and admin expense budget is divided into variable and fixed pieces. Variable selling and admin expenses are 50 cents a unit. Fixed expenses are 70,000 per month. Also note that the fixed expenses include 10,000 in non-cash charges, so primarily depreciation. The selling and admin expense budget then is going to look fairly similar in a sense to our overhead budget in its construction. So we're starting this time with budgeted sales though. Since this is a selling and admin expense budget, it should be driven by sales. So budgeted sales here for April, 20,000 units. We had a variable selling and admin expense of 50 cents per unit. So total variable expenses, 20,000 times 50 cents or $10,000. We had fixed expenses of $70,000, so total expenses of $80,000. And then we also want to do that thing where we have the second total that shows just the cash expenses or the cash outflows. So we'll take the total S&A expenses of $80,000 minus the $10,000 in non-cash expenses, and that gives us our cash disbursements for S&A of $70,000. And then we'll do the same for May, June, and the quarter as a whole. So driving off budgeted sales to get our total variable expenses, adding in our fixed expenses, and getting that first subtotal of total S&A expenses. That's what we'd reconcile to on the budgeted income statement, right? Total expenses. But then we'll deduct the non-cash expenses to show the total cash outlays for these S&A expenses. We want to reconcile that to our cash budget. So for Royal here, for the company as a whole, total S&A expenses were $260,000, total cash portion $230,000. That brings us to learning objective 8, prepare a cash budget. So the cash budget is typically split up into 4 sections, or at least 4. First would be cash receipts. We're going to show all the cash inflows from collections of credit sales, things like that. Second, we're going to show the cash disbursements. It's going to show all of our cash outlays for payments for things like materials, labor, and so on. Excluded from that, though, are repayments of borrowings. Third section, which is really a subtotal, is the cash excess or deficiency, which determines if the company will have to borrow some money to kind of stay afloat operationally, or if we'll be kind of repaying funds that we previously borrowed if we've got an excess. And then section 4 there will be the financing section. It's going to show any of those borrowings and repayments over the course of the particular period. So let's look at Royals here. We're going to need a little more information in addition to our previous budget stuff. Let's assume that Royal has a 16% open line of credit with some bank for $75,000. They can borrow as much as they need up to that at any one time. Let's assume they also want to maintain a minimum cash balance of $30,000. Okay, I don't want to run the well dry. I want to make sure they have some cash on hand to do whatever they need to do. Let's also assume they borrow on the first day of the month and repay loans on the last day of the month whenever they need to do that. Let's assume they pay a cash dividend of $49,000 in April, and that they purchase some equipment in May and June, $143,700 in May, $48,300 in June, paying for that entirely in cash. And let's say they had an April 1st cash balance of $40,000. So let's put together Royal's cash budget. Okay, so April's beginning cash balance we were told was $40,000. That gets us started here. We're going to add to that our expected cash collections coming right from that schedule of expected cash collections of $170,000. That would give us for April a total cash available of $210,000. Then we'll deduct all the expected cash disbursements. So we had $40,000 for purchases of materials. That's from that schedule of expected cash disbursements for materials we'd put together. We've got expected labor cash outflow, $13,000. $56,000 in overhead from the overhead budget. $70,000 in selling and admin expenses from that budget. Then we mentioned the special dividend there of $49,000. Total disbursements then of $228,000. Now we can see where this is headed. That would give us a projected deficiency of $18,000. That's the cash available $210 minus the disbursements $228. So we think we'd be short $18,000. Now because Royal wants to have this minimum cash balance of $30,000, they're going to have to borrow $48,000 on the line of credit. $18,000 to get to zero, $30,000 more to have that cushion. So there's our borrowing of $48,000, ending cash balance $30,000 projected. Then we'll carry forward to May here. Ending in April of 30 becomes beginning in May of 30. We had cash collections expected of $410,000, so that gives cash available of $440, minus total expected disbursements of $400 across all of our individual disbursement items. That would give us a projected excess of $40,000. We can't repay that borrowing of $48,000, so we'll just leave our ending balance at $40,000. And then finally in June, we're carrying forward that balance of $40,000. We had expected collections of $360 to give us cash available of $400. Our disbursements totaled $269,500 from our individual other budgets there, labor, materials, and so on. which would give us a projected excess of $130,500. Now we can budget for the repayment of that draw on the line of credit. So we're paying first the $48,000 principal plus interest. So 48,000 times the 16% interest rate, and then we'll use simple interest, 3 months out of 12. So that gives us total interest payment of $1,920. We're saying that's what's being paid on June 30 for interest there. So deduct those things from our projected excess here, and we're left with an ending cash balance of $80,580. Worth pointing out that that's what we should see on the budgeted balance sheet then for this period under the cash account. That point in time ending cash balance, that asset account should tie out here to our cash budget. Now that we've finished our cash budget, we could really look at the first big output of the master budget process, that budgeted income statement. And that's learning objective 9, is to put one of those together. So the budgeted income statement should look like a historical income statement, a backward-looking one, but it's just looking forward. So we'll use, for this purpose, our traditional format income statement. We're starting with sales, and that's right from the sales budget, minus cost of goods sold, and that's from that ending finished goods inventory budget. So $1 million in sales minus cost of goods sold of $499,000 gives us gross margin budgeted of $501,000. Then we'll deduct all those selling and admin expenses. And again, that's the total from the selling and admin expense budget of $260,000 for a projected operating income of $241,000. Finally, we'll deduct our interest expense from the cash budget there, and that'll give us our overall net income, $239,080. What we're saying is, based on all this budgeted activity we have for the upcoming period, we're projecting net income of a little over $239,000. Then finally, we'll put together a budgeted balance sheet, that point in time projection of our financial position. And we're going to need all the other component budgets plus a little bit more information here. So for Royal, let's assume that we've got the following things from our historical financial statements. We had land on the books at $50,000, common stock at $150,000, retained earnings equity account $248,650, and then equipment $175,000. Now here's Royal's budgeted balance sheet then. If you recall from accounting principles, you're starting with assets, and we're trying to show that assets equal liabilities plus stockholders' equity. Looking at our assets first, we've got cash. Again, that's coming right from the cash budget. We've got accounts receivable, and that represented the ending accounts receivable balance from that expected cash collections schedule we put together for sales. We've got raw materials inventory from our materials budget, $4,600. We've got the finished goods inventory from that budget, $24,950. We've got the land we just spoke of for $50,000, and the equipment that includes those 2 equipment purchases we were planning for in this upcoming period. So total assets of $617,130. Then under liability and stockholders' equity, we've got our accounts payable, $28,400. That was from our schedule of expected cash disbursements for materials. Right? We're going to be paying these things off over time for those materials purchases. So there was the unpaid amount at the end of June 30 that we were expecting. We had the common stock of $150,000, and then retained earnings, got to do a little more math for. We had that beginning balance from our previous balance sheet of $248,650. We would add to that our net income from the budgeted income statement, $239,080, and then subtract any dividends, which in this case was the $49,000 single dividend. And that gives us our ending balance shown here, $438,730. So the budgeted balance sheet is really just an output of this master budget process. I shouldn't say just, it's very important, but it relies on all those other component budgets we've put together up to this point. So it's bringing all that together plus some other information to kind of carry out those last few items. And that wraps up our discussion here of the master budget process. Feel free to review anything you'd like to. Let me know if you have any questions, and then move on to practice problems.